it just creates another level of murkiness that is done, again, to protect the management and not the investor.
Welcome to Zer0es TV. We are very pleased to have a special guest in the studio today. Danny Moses, welcome to Zer0es TV.
Nice to be here. Thanks for having me.
So Danny, you have been an essential part of some iconic Wall Street moments. Tell us your background and how you got there.
Yeah, so I guess right out of college, worked at MBIA, Muni Bond Insurance, which wasn't sexy at all at the time. The later version of MBIA, which got embroiled in the crisis, financial crisis, is a different story, but I was underwriting colleges and airport bonds, pretty basic stuff. Went back to get my MBA at Emory in 1995, came back out and was institutional equity sales at Oppenheimer in 96. That's where I met Steve Eisman and Vincent Daniel, characters in The Big Short. During that time period, I got to see the internet bubble happen in 2000 and watch that blow up. There was also a subprime crisis tucked in there at the same time. It's the first iteration. 9/11 happened. We were all down at One World Financial for that and saw that thing firsthand, so it had a lot of impact, especially on me and people that I worked with. And so from there I kind of needed a change and switched firms in late 2002, early 2003 to Friedman, Billings and Ramsey, a small firm down in Arlington, Virginia, and worked in the New York office. And they were the creators of a lot of these subprime companies that ended up being the shorts in The Big Short. And so I saw how the sausage was made there firsthand, and then jumped to the buy side to work at a hedge fund with Steve Eisman, Porter Collins, and Vincent Daniel at Front Point in 2006. And the rest of that is history. And then from there, ran a hedge fund after Front Point disbanded with Porter Collins and Vincent Daniel, and traded financial services long short. We did fine, but as macro tape and the Fed printing money was a tough environment, so we returned the capital in early 2017. And since then, I've been looking at a variety of industries, and it's been fun to be an investor and an advisor, along the way. So there's a lot of stuff in there, we can talk on, but that's the basic gist of it. So.
Okay, well let's jump into the MBIA time was Orange County.
Correct. So that was the first crisis I saw. Well, actually, first crisis was freshman in college in 1987 in October, when my parents called me and they said, "Oh, you need to get a job," because yeah, and I said, "All right." So I was an umpire for softball games around the university at Emory. But anyway, 1994, I believe it was, Orange County. So a lot of these CIOs at these counties, right, they find a way to obviously stretch returns or enhance returns because the pensions and so forth benefit from it. So Merrill Lynch, I believe, was advising Orange County at the time and allowed or convinced the CIO at Orange County to try to leverage his return. So instead of whatever the number would be, getting 4 or 5%, put on a little extra, take on some leverage using derivatives without going into too much detail, and stretch the returns. Well, leverage is always the killer of everything, right? So when things blow up, they blow up because of leverage. And the trade went against him, probably in a small amount, but because it was levered, Orange County basically had to default or was about to default on their bond. So MBIA insured Orange County. So I remember being called into a large auditorium like, Orange County's in trouble, and the other, and MBA stock took a hit. It's kind of my first iteration with what a crisis can happen and what it looks like. You have a leveraged derivative trade go wrong. During that time period, right after that, when I was going to get my MBA, I interviewed at Long-Term Capital. I was in the Greenwich offices, and this must have been like 95, 96, and I was blown away on the derivative side of what they had. They said, "Do you know what beta is?" I'm sure. It goes, what delta is? I'm like, "Yeah." "How about gamma?" I'm like, "Yeah, I know that." And they go, "What about vega?" And I'm like, "You know what? I'm out of my element now." So while I was in graduate school is when Long-Term Capital, or soon after that, was Long-Term Capital started to kind of blow up. That was another iteration of not understanding, but trying to realize how powerful leverage and derivatives can be. And the rise and fall of Long-Term Capital when Genius failed is, I always recommend to anyone I talk to or kids that come to me for advice to read that book, because it really teaches you about that. Anyway, so MBA was first, and then that followed soon after. So it kind of gave me a setting for what can happen, what can go wrong versus what can go right in the market.
And I realize that it's, the derivatives are not an exact analogy, but what we're going to be looking at post-COVID here. Is there a correlation to what some of these cities are going to be looking at on some of this?
Oh, we've already seen it. I don't think the smoke has cleared yet from what budgets are going to look like. If I was a public worker in a city or a town, I'd be very concerned about, what are the long-term ramifications for the pension? I'm working 25 years for the city or the state, what is that going to look like over time? So I think that's a massive issue. It's going to be years before they can catch up, and I'm sure there'll be some aid that comes away. We've already seen some, but not enough come the way, whether there's special muni bonds that are issued that are guaranteed by the government for some form, because there's going to need a lot of capital in these towns to rebuild the infrastructure, I believe. So I think we haven't even begun to delve into that yet. That's going to be a massive issue. We're sitting here in New York City. It's nice to be in the city. It's nice to not be wearing a mask and talking to you. I feel almost human at this point.
It's a strange feeling.
But you and I both discussed coming in here. I drove in, you drove in, and not even thought about taking public transportation right now. Just if you don't have to, why would you? I can't imagine the MTA. We've already seen what they're running as far as budget deficits, but those are long-term issues that are going to be with us for some time. Some of these were already inefficient, but COVID exacerbated it, and I think that's going to be an issue. So I haven't really delved into shorting muni bonds or anything, but there will be derivatives or are derivatives on that stuff now, and I'm sure that people have started to hedge some of that exposure, but I'm not in tune with all that going on. But it is going to be a massive issue for sure.
Post MBIA, you said you went back and got your MBA.
Yep.
And then where'd you go after that?
Oppenheimer. Institutional equity sales covering mutual funds and hedge funds. Ended up finding my way back down south to Atlanta to cover the southeast region because hedge funds were just kind of growing then, and learned a lot from my clients at the time. I was covering state pension funds and some hedge funds, and so it was a great learning experience. And covering stocks in all sectors as a salesman. Steve Eisman is the financial analyst that Vincent Young and Meredith Whitney worked for him. That was one iteration. Then we had the internet. We had Henry Blodgett was one of our analysts. I got to see firsthand both sides of the equation at the same time. And so 1998, 1999, 2000, watching fiber optic companies and watching subprime auto companies, something was wrong there, right? Things were kind of deteriorating in the economy at the same time. And it all comes back to one thing, right? It's the Fed, and it's the inability of the market to deal with higher rates and what that does to growth and what that does to equity values or risk premiums. And we can talk about that later, but it's always rates that causes dislocation, if you want to call it, in the marketplace. So rates are low like this and the Fed's printing money and no one asks questions. When the tide goes out and you can see what you're really looking at, that's when people ask questions. It's always too late at the end. But you could see it coming in 98, 99, and just like you could see it coming in 2004 and 2005. It takes some time for these things to work their way through the system. But fundamentals I will always stick by are the driving factor in anything you're going to analyze. There's short-term situations where liquidity trumps all, obviously. There are certainly situations where it can go on for much longer than you think. But so my first iteration was .com and then 9/11, and then the resiliency, which was inspiring after 9/11 of how the city and the market responded and the country responded. So that was that piece of history there. So
from Oppenheimer, you.
Yeah, right. I left and went to Freeman Billings and Ramsey. They were a regional firm, kind of a boutique firm. It was actually founded really upon depositing money in banks around the country, waiting for the conversion, that we call a second step conversion into real banks. And then from there they were involved in the tech markets, and then they found the mortgage market. And the mortgage market was crazy in 2003, 4, and 5 because rates were getting cut, and product ingenuity, subprime mortgage market, and they built these companies. And there was something wrong in the time. It was a lot of people were making a lot of money. They were both involved in these companies and they were banking these companies. It just didn't feel right. It felt like it was unsustainable. And so from there, in late 2005, early 2006, I left. It's not because there was anything going on. It was just I could see the end coming, and I wanted to get to the buy side, to a hedge fund, time to short everything that was being created, not just by them, but just in the markets. You could see the fluff, and it's chronicled, obviously, in The Big Short, so I won't go into that. But that was a real learning experience, seeing how the sausage was made, right? Seeing how these mortgage companies were built. And so Trojan horse was obviously home price appreciation, among other things. But once that stopped, everything else kind of fell apart around it. So,
were there any other particular? You said you could see it coming. Were there what were just if you could roadmap some of the signs that you saw, and you were like, oh yeah, here's step 1, step 2.
Yeah, I think that the models that were showing, and so if you were in 2003, the models that were in 2004, 2005, 2006 for these companies, I just didn't think was realistic in terms of, I won't get too technical here, but gain on sale margins weren't sustainable. The amount of mortgages that could be refinanced continuously, the math just didn't work for that amount of origination. At some point you have to stop refining and rates will go up. So the models never really focused on home price appreciation, and Moody's and S&P, the rating agencies, were giving the AAA rubber stamp to a lot of these mortgages, a lot of these companies, and they get paid to do that, obviously, and it's up to the investor to look and see what the root is behind it. But that was really the wake-up call, is what does it take to be AAA, Moody's and S&P, and if you can find out what it would take to get downgraded, which would be any home price degradation in the marketplace or higher rates or combination of both, that was the trigger. It was going to happen eventually. You couldn't sustain this. And when you're talking to, people talk about the shoe shine analysis, and someone talks to you, or a cab driver asks you a question. I had friends in my life that were kind of lost in their careers, that all of a sudden owned multiple homes, they were flipping homes, they were doing these things, and it's not natural in terms of that type of sustainability. Nothing is that easy. And so it became, when money's too easy to be made, you just got to take a step back, recognize it. People hate that. People don't want to hear that. But it's kind of the psychology, behavioral finance aspect of which I pride myself on, behavioral finance. It doesn't always work. The timing's always off. But if you can recognize it and harness it, I think it can work for any trading evaluation. It doesn't matter what the sector is.
Well, it's a situation. It's probably better to be out too early than too late.
Yeah.
So
Yeah.
You're now, from what I hear, very big on cannabis.
Yeah, I mean, when I left kind of the hedge fund world in early 2017, I just could apply my brain to other things and see what was met some people in the sector. A lot of the companies, I spent the first kind of 6 months meeting companies, calling companies, and seeing what the deal was, learning the legality, learning the arbitrage between medical and adult use, and kind of the trends that were going on in the space, and realized it was a home run macro trade. It's the micro where the issue is and was and continues to be. And we're now seeing separation of the winners and the losers, the companies that figured out how to capitalize their balance sheets correctly, how to not rely upon their publicly traded securities for capital. But yeah, that trade right now, especially, we touched before about state budgets, local budgets, it's now off to the races. And we're now seeing companies come into their own. And we're now seeing, with the recent presidential election and even the Senate potentially, the tailwinds. The big headwind still and has been some type of banking legislation, or the ability for these U.S. companies to trade on U.S. exchanges. And there's been a scarcity value that has been associated with the companies in Canada that have been allowed to it. So when I first started looking in the space, you had the Canadian LPs trading on NASDAQ and New York Stock Exchange, but you had the U.S. MSOs, the multi-state operators, trading up on the junior exchanges in Canada. That's a problem. One, because a lot of U.S. investors couldn't access it. I recognize that. And the private markets, I think, has drawn a lot of money. In the middle of all of this in the last 3 years, hemp comes along. And what's really interesting about CBD, and it's here to stay and so forth, is there were a lot of money that was on the sidelines that could not invest in cannabis because either the job didn't allow it, their fund didn't allow it, right, or their brokerage firm didn't allow it. But when hemp came along in CBD and it was, quote, legal, money poured into that business. And there's some good investments, there were some bad investments, but hemp evaporated. The idea that you could invest in hemp and it's like cannabis was just completely different. It's much more commoditized. Watching the fits and starts in cannabis over the last 3 years, and there was people long before me that had done the legwork and that I was trying to learn from, has been really interesting. But it is now it's going to be a CPG. We're going to, a consumer packaged goods company. It's going to be just like alcohol. And you're seeing now the investments from CPG companies, alcohol companies trying to get a piece, because what's interesting in the cities and states where cannabis is legal from an adult use perspective, not just medical, sales of alcohol are getting hurt, and people are choosing cannabis instead. So you're seeing now a lot of activity around, and I think we're going to continue to see it. There's still a scarcity value for companies that trade on the U.S. exchanges, and over time that'll dissipate. I think the medical application side of cannabis is real for PTSD, for opioid addiction. That was what made me most curious at the beginning, was how states can change their medical prescription programs from dentists prescribing opioids for getting your wisdom teeth pulled to medical grade cannabis. And it's not as addictive, obviously. I won't go into all the pros and cons of effects on the brain, but to me that was a no-brainer. So we're slowly seeing this shift. The drug companies have put up a fight, obviously, because why, if you can smoke cannabis and fall asleep, why didn't you take Ambien? I would argue that I would take the natural product. Long way to go, still early innings, exciting from regulatory, and sports gambling is the same. Another vice, if you call it, that state and local governments are going to need the revenue from. So we talked before, the holes in these budgets. I don't see how this stops. Majority of Americans approve of medical cannabis. Well, majority of Americans approve of all cannabis, but it's like 90% medical and over 65% recreational use. So it's going to be, we're 5-10 years from now, we'll think of it like we do alcohol.
Apparently a majority of Americans also agree with sports betting, at least in New Jersey. They just had,
the numbers are off the charts,
yeah,
too. It's really
ridiculous
it's really
amount
amazing.
of revenue this year.
Yeah.
I'd been involved in that in previous lives too.